Cost of capital. Points of discussion. Cost of In cost of capital, we would study cost of debt, preference shares, equity, retained earnings, combination of cost and weight of each sources of capital, combination of cost and their weights, and then weighted average cost of capital. Meaning of cost of capital is return expected by the providers of capital, that is shareholders, lenders, and the venture holders, debt holders. What is the significance of cost of capital? Evaluation of investment options. By knowing the cost, we can evaluate the investment option. It helps us in financial decision. Cost of capital helps us in financial decision. It helps in designing the optimum credit policy. Determination of cost of capital. How do we determine the cost of capital? Cost is not amount the company plans to pay. It is not the amount the company plans to pay or actually pays. Rather, it is the expectation of the stakeholders. Okay, so it is expectation of the stakeholders. It is not the amount the company expects, plans to pay or actually pays. Okay, to calculate cost, we have to calculate the cost, we have to identify various cash flows like inflow of amount received at the beginning, outflow of payment of interest, dividend, redemption amount, etc. Inflow of tax benefit on interest or outflow of payment of dividend tax. So we have to consider inflow, outflow, and tax benefit on interest, inflow of tax benefit, and outflow of dividend tax. So we have to consider inflow, outflow, and inflow outflow taxes. Thereafter, we use trial and error method to arrive at a rate where present value of outflows is equal to present value of inflows. Okay. So when it is like present value of outflow is equal to present value of inflow, it is basically called IRR. Okay. Cost of long-term debt, KD. Do not confers ownership. Long-term debt does not give ownership to the providers. Debt providers do not participate in the affairs of the company. They get charged on profit before taxes in the form of interest. Cost of long-term debt, cost of irredeemable debt, cost of redeemable debt. Irredeemable debt formula is KD equals to interest into 1 minus tax upon NP. Right? Net proceeds. KD is cost of debt after tax. Annual I is annual interest payment. NP is net proceeds of debentures, new debentures, or current market price. Existing debentures. Tax rate T means tax rates. Net proceed means issue price less issue expenses such as flotation cost. Cost of irredeemable debentures. This is approximation method. So in cost of irredeemable, when we calculate redeemable debentures, okay, redeemable debentures, there are two methods. In irredeemable, there is no method. There is only one, this formula, okay, which is a direct formula. But when we calculate redeemable debentures, there are two methods. First is YTM method. Oh, sorry. First is YTM method, and the second is formula method, or you can also say approximation method. Okay, so first we are seeing the formula method and then we will go for YTM method. Okay, so this is approximation method, or you can say formula method. KD equals to interest into 1 minus tax plus RV minus NP upon N whole divided by RV plus NP upon 2, where I means interest payment, NP means net proceeds new or current market price old, RV means redemption value of debentures, T means tax rate applicable, and means remaining life of the debentures. Formula is used only where only interest on debt is tax deductible. When it is tax deductible, only then formula will use. Sometimes debt are issued at discount and redeemed at premium. If such discount on issue or premium are tax deductible, then this formula can be used. So when only interest is tax deductible, so we will do 1 minus tax next to interest only. But when question specifically says that redemption value is also uh, redemption value is also tax deductible, then we have to do 1 minus tax next to the whole formula. Got it? When only interest is tax deductible, only interest only next to interest this will 1 minus tax we will write. But if redemption value, net proceeds, everything is tax deductible, well, not everything, but yeah, if redemption value is tax deductible, then we will use this 1 minus tax formula. Got it? Using present value method. Now the first approximation method is done. Now we will calculate a present value method. Yield to maturity. YTM approach. YTM approach. What is YTM? Internal rate of return at which current price of debt equals to present value of all cash flows. Current price equals to present value of all cash flows. Okay, so this is the YTM method. Steps to calculate relevant cash flows. So we know we wait. Mm, so we know the current price, but how do we calculate present value of all cash flows? So step to calculate relevant cash flows. First identify the cash flows, then calculate NPV, net present value of cash flows identified above. How do we calculate NPV? By using two discount rates. By using two discount rates and then calculate IRR. Identify the cash flows. Year 0, net proceeds in case of new issue, market price in case of existing debt. 1 to n years, interest net of tax and redemption value. Calculate NPV of cash flows as identified above using two discount rates. We identified the cash flows above. Now we will calculate NPV using two discount rates. Okay, guessing. To get each a positive NPV and a negative. So we are using two discount rates. So we will get one positive NPV and one negative NPV. Then we will use interpolation method to calculate IRR, which is L plus NPV L upon NPV L minus NPV H into H minus L. So what is NL? I mean NHL. So L means this is lower rate, lower two discounting rates. So lower rate, net present value from lower rate, net present value from lower rate minus net present value from higher rate. Here higher higher rate minus higher lower rate into, okay. So here H and L stands for higher discount rate and lower discount rate respectively. It is to be noted that higher the difference between H and L, lower the accuracy of answer. So we also have to keep the difference minimum. Yes. Example. A company issued 10,000 10% debentures of rupees 100 each to be mature on 1 April 2021, to be matured on 1 April 2026, which means it is issued for 5 years, right? The company wants to know the current cost of its existing debt. Current cost of its existing debt. If the market price is 80 rupees, what is the current cost of its debt? Considering tax rate is 30. If the market rate is 80, tax is 35, we have to know the current cost of it. What amount we are paying actually. So we will identify the relevant cash flows. So in year 0, there is a current market price of rupees 80. Year 1 to 5, interest net of tax is 6.5. Interest 1 minus tax. So interest 100 into 10% is 10 rupees interest minus 1 minus 0 point into 1 minus 0.35. So the net of tax interest is 6.5. Redemption value is face value 100 rupees because they have not told the redemption amount. So we will take it as par. Now we got all the cash flows. Now we will calculate NPV at two discounting rates, right? So year 1, 0, 1 to 5 and 5. Cash flows 80, 6.5 and 100, right? So first, we don't know which discounting rate to take. So we will take 10 only. Okay, so discounting rate is 10. So 1, 3.791. This is annuity. 1 to 5. I did all the discounting factors. And 0.621. We will multiply it. We got positive. Okay, so whenever we got the positive amount, we increase the discount rate. So we got positive, then we will increase 5 more. So it is 15. Okay, so this is the amount, the factor. And then by calculating into cash flow with factor, we get present value. So here we get negative present value. So we got one positive and one negative. So by interpolation, we can calculate IRR. So lower NPV, lower rate NPV upon lower rate NPV minus higher rate NPV into higher minus lower rate. So lower rate, lower, lower rate NPV, uh, lower rate NPV minus higher rate NPV. Multiply by higher rate minus lower rate equals to 12.21. We got IRR. Now we will calculate amortization of bond. We are studying amortization of bond. A bond may be amortized every year. Principal is repaid every year rather than at maturity. So here at amortization of bond, principal is paid every year rather than at maturity. In such situation, principal will go down with annual payments and interest be computed on the outstanding amount. Cash flows will be uneven, right? Because principal is decreasing every year. Value of bond. Value of bond. Cash flow 1 divided by 1 plus KD year 1. Cash plus cash flow 2 divided by 1 plus KD year 2. Dash 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 dash. Cash flow N divided by 1 plus KD N years. Value of bond VB is calculated. Sum of all cash flow upon 1 plus KDT here N here T. So this is how it is calculated. Cost of convertible debentures. Option to either get the debentures redeemed into cash or get specified number of companies share. While determining redemption value, it is assumed that all debentures holders will choose the option which is higher, beneficial to the holder. Either cash or shares, whichever is higher, the debenture holders will choose that option. Cost of preference shares, KP, paid dividend at a specified rate on face value. Dividend treated as appropriation of profit after tax. So here tax deduction is not. We don't get tax deduction. Does not reduce the tax liability of the company. Yes, so it does not save our taxes. Cost of preference share capital, irredeemable preference share capital, redeemable preference share capital. So irredeemable preference share capital KP equals to preference dividend upon P0. So what we pay upon what we give receive, right? So PD is annual preference dividend. PO is net proceeds from issue of preference shares. Net proceeds means issue price less issue expenses or flotation cost. Cost of redeemable debentures is preference dividend plus, here the tax benefit is not there, so we will not do 1 minus tax. So preference dividend plus RV minus NP upon N whole divided by RV plus NP upon 2. So preference dividend. So this is how much we extra pay, right? How much we extra pay, and this is average. Preference dividend means the PD means annual preference dividend, RV redemption value of preference shares, and P net proceeds from the issue of preference shares and remaining life of preference shares. Cost of equity share capital. Equity share capital is the expectation of equity shareholders. Equity share capital is the expectation of equity shareholders. Value is performance divided by expectation. So whatever is the performance divided by expectation, we get equity share capital. Performance means amount paid by the company to investors like interest, dividend, redemption prices, which is uncertain in case of equity. So performance divided by expectation, we get the capital value. There are 5 methods to compute equity share capital. The first one is dividend price approach, second earning price approach, growth approach, realized yield approach, capital asset pricing model CAPM approach. Cost of dividend price approach. Dividend price approach assumes that dividend per share is expected to remain constant forever. KE equals to what we give upon what we receive. So D upon P. Expected dividend and market price of equity is P0. Earnings price approach correlate the earning of the company with market price of its share. So we correlate the earning with market share. So K upon earning upon market price. So E equals to current earning per share, P equals to market price per share. Growth approach or Gordon's model, rate of dividend remains constant. Dividend growth, not dividend, but growth here, there it was dividend was constant. Here the dividend is growing year by year, but the growth is constant by 5% or 2%. The growth rate is not fluctuating. So earnings, dividend, and equity share price will all grow at the same time. So earnings, dividend, and price, everything will grow at the same rate. So K equals to dividend, price, plus growth. So what we give is what we receive plus growth every year. Dividend is D0 1 plus G, that is next expected dividend. P0 is current market price. G is constant growth rate of dividend. In case of newly issued equity share, flotation cost is incurred. Okay. So market price minus like net proceeds, issue cost minus issue price minus issue cost. So D1 upon P0 plus G. So if a flotation cost is given, then we will deduct the flotation cost from market price, because we like even if that is the market price, but we have incurred the cost um, to issue in the market. So always from net proceeds, flotation cost is deducted. Example, a company had paid dividend of 1 rupee per share, face value 10. Last year it is expected to grow, uh, like paid 1 rupee per share last year, and it is expected to year 10% every year. Current market price is 55. So dividend into growth 1 plus 0.1 upon 5.5. So it is D1 upon P0 plus growth rate, we got 12%. Estimation, like when we calculate, how do we estimate the growth rate? How would we know what is the growth rate? So there are two methods, average method, Gordon's growth model. So in average method, the current dividend is dn 1 plus d0 equals to 1 plus gn, right? So growth rate equals to d0 upon dn minus 1 whole root n. So current dividend in n years ago. Other ways, dividend d0 by dn, find out result and then refer the FVIF table. Find out result found at step 1 in corresponding years row. See the interest rate for corresponding column. This is the growth rate. Example, current dividend is D0. D0 is 16.10. Dividend 5 years ago was 10. Growth rate in dividend can found as follow. D1 by Dn. This is, we got it. Find out result 1.61 in the 5th year. See the interest rate corresponding 10%. In table, FVIF table. Gordon's growth model. This model attempts to derive a future growth rate, which is G equals to B into R, which means B means retained earnings and R means return on fund invested. I say like बचे हुए earnings पे return. Okay, so retained into return. Proportion of earnings available to equity shareholders is which is not disturbed as dividend. So Retained earning means earnings available to equity shareholders which is not distributed as dividend. Realized yield approach. Average rate of return realized in past few years historically regarded as expected. So average rate of return realized regarded as expected return in future computes cost of equity based on past records of dividend actually realized. Mr. X had purchased a share of ABC Limited for 1000 and received dividend for 5 years at 10%. At the end of 5th year, he sold the share for rupees 1128. The cost of equity as per realized yield approach would be as follows. It would be discount rate which equates the present value of the dividend received in the past 5 years plus present value of sale price to the purchase price. The discount rate which equals these two is 12%. Purchase share for 1000, received dividend 10%, sold for 1128. Okay. 10% is always 100, right? Like 1000 into 10% is 100 in each year. So it would be discount rate which equates present value of dividend received plus sale price. So 1, 2, 3, 4, 5 years dividend, sale 1128, discounting factor present value. So this is realized yield approach. Here we don't calculate NPV, we just sum everything. Capital asset pricing model, diversifiable or unsystematic risk related with company's performance, can be eliminated by investor through diversification. However, non-diversifiable or systematic risk, a macroeconomic or market-specific risk, is the risk which cannot be eliminated. Thus, a business should be concerned as per CAPM model solely with non-diversifiable risk. Cost of equity under CAPM. Risk-free rate plus risk premium. Risk-free rate, risk premium into beta. Beta is risk measurable, coefficient of risk measurable in market. So risk-free rate is when we invest in FD. Market risk is when we invest in capital market and when we invest in FD. So this is in market we are taking risk. So this is a risk premium. So risk free plus risk premium into beta. Risk premium into beta plus risk free. So we get KE. K is cost of capital, risk-free rate of return RF, beta coefficient represents systematic risk rate of return and market power portfolio RM minus alpha RF market risk premium. Risk return relationship of various securities. Government bond risk, corporate debt risk, preferential equity share. This is a risk. This is risk, and this is a return. Yeah. Example, the risk-free rate of return equals to 10%. The company's beta is 1.75. Market portfolio is a return is 15%. The cost of equity would be risk-free risk plus premium risk into beta coefficient. So this is 18.75% risk. Cost of retained earnings KR, it is the opportunity cost of dividend foregone by the shareholders. Because company retained it, so shareholders foregone it. Formula used for calculation of retained earnings are same as used for calculation of equity, right? Same formulas. Price method, earning method, growth method, same. For KE, P equals to net proceeds realized. Issue price minus float. So when we calculate for equity, we always deduct flotation cost from net proceeds. But for KR, we don't deduct flotation cost because we are not issuing something. Because uh, to calculate to get the money of from equity shareholders, we have to issue shares, so we incur flotation cost. So that's why we deduct it. But if we are not issuing anything, we are just retaining the money, so we are not incurring any flotation cost. That is why we don't deduct it. However, sometimes issue price may also be used, ignoring flotation cost. For P, we only use current market price. So for KR, we use market price. So when we calculate KE, we give preference to issue price and then current market price. But when we calculate KR, we give preference to current market price and then issue price. Right? But flotation cost will never come in KR. Weighted average cost of capital WACC, company mix various sources of finance. Cost of total capital will be equal to WACC of individual sources of finance. How do we calculate WACC? Calculate total capital from all sources, long term plus preference equity retained. Calculate proportion of each share of capital, which is a weight. Calculate weight, multiply the weight with their cost, and then we will get aggregate the cost of capital, then we will get the WACC. Multiply weight with cost and sum it, we will get WACC. Choice of weights. Book value weights, market value weights. Operationally easy. Book value weight is operationally easy and convenient. Reserves such as share premium and return profits are included in book value of equity. Reserves are retained earnings are calculated in case of book value. But in market value, it is more correct and represent capital structure, preferably to use market value for the equity. It is preferable to use market value. Reserves reserves are ignored here as they are in effect incorporated in value of equity. So the reserves are already included in value of equity. That's why it is ignored. No separate market value for return earnings, but here it is separate value for retained earnings. Example, cost of capital structure are as follows: debenture, preference shares, equity. Market value are given. After tax cost of capital is given. We will calculate cost of capital, mark applying book value weights. This is all book value weights, cost, multiply it, sum it. Book value WACC. Market value WACC. Calculate the market value, sum it. Give weights, calculate cost, multiply weight with cost, and then got WACC, which is market value weights. So cost of capital chapter is finished. Revision is finished.